We're having quite an incredible green day in the market, and especially for those who hold semiconductors quite significantly in their portfolio. In fact, under the spotlight today, AMD is up more than 5%, and this is a company that is up 14% year to date. It wasn't that long ago where it was trading at its 52-week low, and in fact it was right there during the Liberation Day period around April, and since then it has been on a phenomenal run. We're talking more than 40% gain if you were someone who did buy it around the 52-week low. Now the question is it too late to buy this company? We notice the 52-week high sits at $188, and this is a company that over the last 10 years has massively outperformed the S&P, up more than 5,000%. So we're going to get into that today and understand if it is in fact too late. And one of the main reasons why we're seeing this company shoot up by more than 5% today is that they did finally get a rating upgrade, something we haven't seen in quite some time for the company, and that is from Melius. In fact, this was a massive raise from $135. They now believe this is intrinsically worth $211. They're not the only ones this month who are increasing their price targets, although not to the same extent. We have one analyst bring it to $140. We have another one that reiterated that exact same price, as well as Evercore, who did go slightly higher to $144. Now it is worth considering, after the very strong run we've seen in just a matter of months, the company now sits around the $138 mark. That is pretty much the extent of what analysts believe is the intrinsic price, as we just highlighted. Let's take a deeper look to see what the answer is. Now we do have some news that was just released hours ago, very bullish for AMD, where this deal puts their chips at the center of major digital and AI projects, meaning more demand for their processors as businesses upgrade their technology. And we just heard a few weeks ago from their AI conference they will be introducing the MI350 series, something we're going to discuss shortly as well, but also the number of companies they are partnering on looks to be absolutely phenomenal. We're talking Meta, OpenAI, Oracle, Microsoft, as well as many others. And they also announced the Helios AI server, which is going to launch in 2026. This will ultimately rival Nvidia's top offerings, and we have many companies already looking to buy a significant amount. In fact, we had one particular that were planning a $400 million purchase. And given all of this bullish news, we can see that AMD, Lisa Su in particular, believes that they are on the right path to really challenge Nvidia. Although speaking specifically about data center, we can see the gap in the market share is quite significant. Nvidia sit well above 90%, whilst AMD are sitting in the single digit. But that isn't necessarily bad news. It does in fact mean AMD have room to grow. In just that conference, Lisa Su was talking about how she expects the market to grow 60% every single year, and we can see in a bit more clarity that that is a total addressable market in 2028 of 500 billion, with a large portion of that coming from inference. And not only are they releasing the MI350 series, but they're also looking to 2026, something we consistently applaud Nvidia's management on, as we like to see companies who are looking to the future, the next few years, in terms of what products they're going to bring out. And just speaking on this latest series, we can already see how much of an improvement it is just on the previous one, and it also delivers the highest inference when compared to Nvidia. And some very bullish news for the company. On top of Llama inference, we can also note Meta's AI recommendation and training models run on these GPUs. We also have the partnerships with Oracle, as well as many others. It does really make us believe things are only getting started. And we also have Microsoft. Now, one of the things that got analysts most excited about was the Helios, the next generative AI server launching in 2026. Now, this is built around 72 of their upcoming AI 400 chips, and it's designed to compete directly with Nvidia's top AI servers by offering high performance, scalability, and open standards. And they're gonna aim to make this a key platform for major players like OpenAI, Meta, Turn, by providing an open, flexible alternative to Nvidia's more closed ecosystem. And it is looking like things are only just getting started, with 2026, the MI400 series looking like some real strong improvements from even the upcoming MI355, and in fact the MI400 has noted it up to 10 times more performance. Now we also need to consider that this company is in a cyclical industry. That is noted through the numbers. Whether we look, for example, at the free cash flow per share, there is no real consistency. We do, however, like the fact that over the next 12 months, free cash flow is expected to really rocket up. Again, sales growth, no consistency. We're not surprised. The only thing we would say is when we, for example, compare it to Nvidia, which is also in the same industry, you don't really get a large sense of that cyclicality, which could point to the fact that Nvidia is, at least for now, a higher quality company. And when we continue onto the other metrics for AMD, we still like the company overall. Their top line has been growing at a phenomenal rate. Very similar to most companies in this industry, they have been diluting your position as a shareholder. As we note, it has been increasing. However, one good thing about the company, they have massively outperformed the S&P, so right now we wouldn't say it is a red flag indicator. ROIC, again, inconsistent as we go, and Nvidia's, for comparison, we get some very strong numbers, and the margins also reflect that cyclicality. However, what we would say, net debt to EBITDA looking very good, 0 from 2019 onwards, highlights really strong balance sheet, as these are the number of years it would take them to pay off all of their debt, not even one day for the company. They've also had some fairly consistent earnings. They've either outperformed analyst targets or been in line. That is effectively a 100% track record, and their previous quarter did show some very strong growth. We're talking 36% year on year, the major driver being data center up 57%, given that does effectively take up 50% of their top line, as well as efficiencies. Notice their gross, operating, and bottom line, 3, 10, and 7 respectively. We would also point out that institutions hold around 71% ownership, where they sold around $19.6 billion in just the last 12 months. They bought a little bit more at 20.6. However, what we really like to see is that in the most recent quarter, they bought more than they did in fact sell, so you can argue institutions a little bit more bullish than bearish. Also worth highlighting, only 2 super investors hold this company in their overall portfolio. For comparison, we have Nvidia, where 27 of them hold the company, and maybe more fascinating is that in quarter 1, we actually got one super investor, billionaire David Tepper, fully selling out. He would be up quite significantly if he held on to these stocks, and we also noticed the other 2, in fact, who were the only ones to hold AMD, were slightly trimming. Doesn't necessarily mean anything, but always good to see what super investors both buy and sell. And just before we get into the valuation, we want to highlight that we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of June. Lots of information for each one, as well as the upside that Wall Street see over the next year. And you can also grab a copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our intrinsic price for AMD gets to $137 derived from the DCF. Straight away, given the current price does sit around that level, this highlights to us, in our opinion, we believe it's trading at its fair price. We'll highlight the inputs so you understand where these numbers are being generated from, but we have the free cash flow year on year. Average is negative. We can see it skewed positive to negative number of years. Again, cyclical industry, although not something we saw with Nvidia. Growth rate moving forwards, 25%. Now you can see low, medium, and high, 20, 25, 30 respectively. As always, numbers here are fairly subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for AMD or any others. But 25% with a discount rate, we get the present value of future free cash flow and terminal price. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 137, as we noticed, 0% upside, because effectively already baked into the numbers. So if you're buying this company today, is 25% growth to the future free cash flow. Ultimately, you need to believe this is higher, otherwise you're not really getting any true value. For those that believe it should be even lower, well, at 20%, $98, indicating downside of 28%, something we saw not that long ago. As we highlighted, Liberation Day, the company was below $80. And for those that believe we should be a lot higher at 30%, well, $190, indicating 39% upside. Now, typically on the channel, we do like to take through the middle rate at 25%, where we apply a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at $123, then we keep going. 20% a buy at $110. Really depends on what margin of safety you want as an investor. $103, $25, and we can also show at $30, $96. So we see this right now trading at its intrinsic price. On average, we did get some upgrades to the price target, but Wall Street see this $133, meaning downside of 3% into 2026. As always though, do give us your thoughts below. Is this one you believe, as of now, after the massive jump, is a buy, hold or sell? We'll also show, for those that believe we should be using the more optimistic rate of 30%, what the MOS would be. At 10%, a buy at $171, and as we keep on going to see what the margin of safety is, you're not getting 30% just yet, pretty much sitting around the 25% level. That is, as we said, if you believe they can grow their future free cash flows at 30% year on year. Most recent year sits 115%. Give us your thoughts. Wall Street, as we know, actually see downside now after this incredible run, but again, buy, hold or sell, let us know below. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.